For investing stocks on long term, first we need to see what to buy and when to buy. For answering this, we need to understand fundamental analysis and technical analysis. In simple words, fundamental analysis will address what to buy, whereas technical analysis will address when to buy. You can build a watch list of stocks based on fundamental analysis and then use technical analysis to decide when to buy. Usually, the general assumption is fundamental analysis is only required for long term buy. But it's not like that. Along with fundamental analysis, technical analysis will help long term investors to time the entry or exit. No matter how strong the business are, if you not bought at the right price, the returns will be lower.
Hi friends, welcome to a brand new segment of FinveStocks, Friday Basics, which will give you good insight about Indian equity market. My sincere effort in this segment is to create awareness to all in simple language. This series will be arranged in such a way so as to understand everyone who are beginners. Please share this video to all those who wish to learn, understand and participate in stock market. Please don't forget to subscribe and click the bell button to get the notifications of upcoming knowledge-packed videos on personal finance and stock market. Welcome back to FinveStocks, where we make everyone understand the basics of money management. Before going into this video, make sure you watch earlier videos of this series, which is mentioned in the I button.
For long-term investment, along with fundamental analysis, technical analysis will help in timing the market. Fundamental analysis can be classified into two, quantitative analysis as well as qualitative analysis. Technical analysis will be based on charting, price action, indicators, oscillators, trends, momentum, historical price, volume, etc. Let's see technical analysis in detail. Technical analysis works on three key principles. The first assumption is all relevant information about the stock is already reflected in the stock price. The second one is stock prices moves in trends. And the last one, history tends to repeat itself in stock market. Based on this analysis or hypothesis, technical analysis works. So what is technical analysis? Technical analysis is the study of historic market data, including price and volumes. Using these data, technical analysts aim to predict future market behavior. Technical analysis is a popular technique that allows you to give a good viewpoint. That means directional viewpoint. It not only helps you develop a point of view on a particular stock, but also helps you define the trade, keeping in mind the entry, exit and risk perspective. Technical analysis also helps in getting price at which one should buy or sell a stock. Also, it will tell the risk involved and expected rewards out of that. Technical analysts don't care whether a stock is undervalued or overvalued, unlike fundamental analysts. In fact, the only thing that matters is the stock's past trading data. That means price and volume data. And what information this data can provide about the future movement in the stock. Before going deep into technical analysis, we should set our expectations on what can and cannot be achieved using technical analysis. Technical analysis is best used to identify short-term trades. Do not use technical analysis to identify long-term investment opportunities. Long-term investment opportunities are best identified using fundamental analysis. Fundamental analysis will tell what to buy, whereas technical analysis will tell when to buy. Technical analysis based trades are very short in nature, so do not expect huge returns out of that. Normally, the trade based on technical analysis will last from few minutes to few weeks. Often traders initiate a trade for a certain reason. However, in case of adverse movement in the stock, the trade starts making a loss. So do remember to cut losses by putting appropriate stop losses and move on to identify new opportunity. Technical analysis is based on few assumptions as explained earlier. Market discounts everything. This assumption tells us that all the known and unknown information in the public domain is reflected in the stock price itself. For example, there could be an insider in the company buying the stock in large quantity in anticipation of good quarterly earnings. While he does this secretively, the price reacts to this action, thus revealing to the technical analyst that this could be a good buy.
Similarly, technical analyst is more concerned about how the stock is moving rather than why the stock is moving. Price moves in trends. In technical analysis, price movements are believed to follow trends. This means that after a trend has been established, the future price movement is more likely to be in the same direction as the trend than to be against it. Most technical trading strategies are based on this assumption. The next principle is history tends to repeat itself. In the technical analysis context, the price trend tends to repeat itself. This happens because the market participants having knowledge in technical analysis consistently react to the price movements in a remarkably similar way. The price also moves in a certain direction consistently.
The three most common form of technical analysis are charting, patterns, and indicators. Let's see each one in detail. Let's start with charting. The commonly used charts in stock market are line charts, bar charts, candlestick charts, etc. Out of these, the most popular one is candlestick charts.
Now let's see the history of candlestick charting. In the 18th century, a wealthy Japanese businessman, Kunihisa Homa, developed a technical analysis method to analyze the price of rice contracts. Today, this technique is called candlestick charting. Homa, from Sakata, Japan, began trading at a local rice exchange around 1750. He kept records of the market psychology learnings to boost his profits by carefully monitoring prices and not to rushing into trades. Homa is regarded as the grandfather of candlesticks because of his research on price recognition pattern. They were introduced to Western world by Steve Nielsen in his book Japanese Candlestick Charting Techniques, first published in 1991. Candlestick charts use the same price data as bar charts, like open, high, low, and close. However, candlestick charts are drawn in a much more visually identifiable way, typically resembling a candlestick with wicks on both ends. The high and low are described as shadows and plotted as a single line.
The green candle shows bullish, whereas the red one shows bearish.
An important pro tip: as technical analysis is mainly for short term trades, never think about a trade without stop loss and target. Where to place stop loss and targets in trading, that we will see in our subsequent video. In our next video, we will see how to represent a candle, what are the different type of candles available, and how the price fluctuation for a particular duration will reflect in a candle, and what are the different types of bullish and bearish candles available in technical analysis. So stay tuned for an interesting session on technical analysis going forward. Please do like if you like the video and don't forget to subscribe to get the notifications of upcoming videos on personal finance and stock market. Please post your valuable comments. Do follow the Friday Basics to make your stock market journey easy. Thanks for watching and have a good day.